Welcome back, my passive income investors. Like to a deep dive analysis of my now $334,000 dividend stock portfolio, of course, for that juicy passive income. We are going to take a broader view of the markets real quick, guys. Take a look at some of the interesting things going on in my personal investment life for the week. And then, of course, dive into the portfolio and take a look at the buys and sells for the week because there's been more than I'm sure you might be anticipating as I continue to consolidate and scale up my higher conviction trades. But as always, just taking a look at the stock twits watch list for the week, you'd be lucky, you'd be damn lucky to find anything green in your portfolio today. Luckily, most of my higher conviction trades here are large cap companies, so I'm really not down that much. The portfolio overall is kind of at all-time highs thanks to personal contributions, but because these stocks aren't trading down much more than 0.5% to 1% at most, it's really not that damaging to the portfolio. But yeah, the markets aren't having the greatest Friday, but it's usually by the Friday dip for that Monday morning rip. But putting that aside, folks, let's just talk about some of these higher conviction stocks like Apple. Been supporting the temple of Apple. I did end up purchasing the iPhone 13 Pro Max, trying to upgrade from my XR that I bought in 2019. I'm a big simp for Apple. I love the temple of Apple, guys. I just wish that the product release was a little bit more exciting. I think most investors were underwhelmed by it. The stock did sell off into this news, and I thought it was pretty good overall, though. I mean, the iWatch upgrades are pretty cool. Now the iPads are pretty much as powerful as the phones, but just to get some better video quality and continue to scale my personal professional career, why not get some better equipment and upgrade from this old stuff? The only thing I wish we got out of the Apple event was the MacBook Pro 16 with the M1 chip, because this is the only thing many of us people that want to upgrade our computers are waiting for, because nobody wants the first iteration of the the MacBook Pro or the 13-inch one that doesn't have a better graphics card that didn't upgrade. A lot of things that they could have done better there. So we're waiting for the next iteration where we're probably going to get much better hardware. That'll probably come out in October release is what I'm hoping, and I'll be picking this up as well. But for now, we'll start with the phone. We'll tell you guys what we think once that comes in. But putting Apple aside, I know many of you aren't into the crypto space, but my old business partner who runs a computer store has personally finally been getting into crypto mining, and I've been learning a lot from this. It's been pretty incredible. I have no investments in this yet, but I told him I will be buying his crypto at the end of every single month while he tries to pay off the equipment, because I'd rather get some Bitcoin out of a personal miner, which I think is really cool. But if this stuff continues to scale and work out, I will be making some investments probably into the mining sector here as well that, can encapsulate my entire, Bitcoin positions, get both sides of the world going on with the holding the crypto, maybe leveraging it, and then also owning the mining space. But I'll put that aside because I know too many people might not be into the crypto mining, but it is really cool to see how some of this stuff operates on the back end. So getting into the personal portfolio for the week, guys, let's talk about the buys, the sells, and as always, first, the overview. Like I said, from personal contributions right now, I think is what's been holding the portfolio up, because generally, I'm sure most of us are aware the market's been generally flat. But even in this consolidation period, buying lower dividend yielding stocks, I'm still kind of surprised that my annual dividend sits at $7,920. So very happy and pleased with that. But let's just talk about some of the consolidation stocks here, because many of you might be disappointed to find out that I actually liquidated my Clorox position. This was sitting in my registered retirement savings plan, and I bought this to continue to add to some consumer staples that offered me some healthcare exposure. But considering I wasn't really down too much on it, I realized that my higher conviction trades that I realized I didn't own enough of, because at this point, it doesn't make sense for me to be owning less to $15,000 to $20,000 in a position. I mean, I look at these things like they are physical cars, and a car, when you buy it, guys, it's got to be reliable. It's got to get you to back and forth from work to make that money, that moolah. But at least these vehicles actually have capital appreciation, though in this hyperinflated market, chip shortages, used cars are still inflating in asset value for the first time in forever, I think. But anyways, what I wanted to do was increase my positions in these high convictions that I have in Johnson and Johnson. So I liquidated Clorox to pick J&J up. I picked Pepsi up. Very happy with these two companies. Pepsi's probably one of the largest held companies in retirement funds. It's much more stabilized. And J&J, I just love. I'm like, I didn't own enough of this. So even selling Clorox and scaling these up still only just teetered them at about a $20,000 position. And then with a little bit of leftover funds, I finalized my VOO position. Not that it's finalized, but at scale, I'm going to say VOO is something that I talk about a lot. I always talk about the index funds, but I kind of want to preach and act what I preach because I haven't really held index funds for a while. And now that my portfolio is at scale and I'm not chasing as higher capital gain returns from, say, smaller cap companies, I figure if even to get 10% off the entire portfolio, I mean, you're looking at a full-time income at a minimum wage job at a $330,000 portfolio, right? So I did end up scaling that up here as well. So we can see that my top weighting positions are all at really healthy levels right now, with Microsoft kind of being the top weighting in the entire portfolio at this point, only next to Ryokan, which if I can find Ryokan in this long list is the second. Well, they're both kind of equally large weighted. So those are the two largest positions at this point is Microsoft, not by choice, just because the capital gains, kind of the same thing with Ryokan, right? But putting the J&J, Pepsi aside, guys, getting rid of the Clorox, I did add a new REIT, which I talked about this week, which was Granite Real Estate Investment Trust. This is a new starter position for me. This is really similar to Stag, and it's only really because I want to find some more stabilized REITs, and I really like Granite Real Estate Investment Trust. It's such a symbiotic relationship with Stag Industrial. It's very stabilized. It's been on this really good up trajectory. The starting yield I'm very happy with, and it trades for a much better valuation than Stag. Largest tenant is Magna. Second largest tenant is Amazon. Over 50% of their portfolio encapsulated with e-commerce, I believe, as well. Very similar to Stag. So I'm going to continue to scale this one up over time. So that's one that we did add this week. The only one that I want to add this week that I haven't been able to is Facebook stock. It's over 20 now, but I want to just add a few more $1,000 to it if I'm being honest. Facebook is just one of the only tech stocks I feel super comfortable buying here. I was thinking about buying more Tesla, but it's up weighted so much in the portfolio, it wouldn't make sense. So the only things that I really want to continue to level off here, and I didn't think I would do it, but maybe perhaps I'll buy a little bit more Google shares here. But I'm more focused moving into the latter half of this year and the last quarter into some of more of these dividend stocks, because obviously the top weightings are mostly at scale. But when we start moving to the lower weightings, and this isn't again by choice, this is just from accounts, because all these things sit in specific accounts that I can only contribute so much to, or the positions just I can't scale them with the current income in my corporation because I can't just pull that corporate money out. So I'm kind of forced to not buy these companies because I don't want to start dividing them up between all these different accounts. But TELUS is one I would like to get to scale at least 15 to 20,000. TD, I'm probably going to focus more on moving into next year when I can make some more contribution limits to my TFSA where TD sits. But I'd like to scale this up, get about 5,000 more in there. Other than that, there's not much else going on other than MPW is the only one that I really want to contribute to with dividends. In the portfolio itself, MPW sits in my TFSA. Is probably one of my favorite dividend stocks right now, which is a hospital REIT. So I'm much looking forward to using my dividends to continue to scale that one too. Again, about $15,000 to $20,000. And because I'm focusing the second half of this year, or sorry, the latter half, the last quarter, in these dividend stocks on the lower half of the portfolio, it should continue to scale my dividends into the rest of the year, which is what I'm hoping. My goal was to try and get to about 10,000 in dividends by the end of the year, but because I'm not like the most dividend solely focused person, and I know a lot of people out there are paying a lot of attention to some of my boys like Dave at Hidden Freedom Investing. You watch PPC Ian, he's had a lot of guys on that are chasing fire. But the fact of the matter is all these people are reaching retirement age and they have a lot more capital than I do. So it's not appropriate, I think, for somebody in their early 20s or getting into their 30s to be so heavily weighted in dividend stocks, though that could be a decision that you feel different about. I personally think that growth matters more in the early stages of your investing career, because this portfolio largely did not come from dividend stocks. It largely came from really great trades like Canopy Growth Corp, MindMed, Tesla. I mean, Apple's been a great growth provider, Facebook. I mean, these list of companies I think can make up for probably more than 50%, 100% of capital gains for this portfolio. So I've recognized the value in that, and I've started just kind of convicting myself to some. And again, these pay dividends. It's not like they're not dividend stocks, right? Like VOO, they all pay dividends. In fact, there's only 3 positions really in this whole portfolio from a stock percentage base that don't pay dividends: Facebook, Google, and Tesla, right? So it's not like I'm that adverse in any way from avoiding dividends. But other than that, yeah, Bitcoin, I'm not getting any yield off of or anything like that, but I am continuing to buy it. I bought a bit more, I think, the other day. I bought about another $200 worth, but I'm going to stop buying it off the exchange. As mentioned, I'm going to continue to buy it off my old business partner. But because of the shifting, guys, my dividends haven't been equaling out the way I want them to, because I'm trying to get away from Ryokan that makes up 13% of the total weighting for dividends. So what I'm going to try and do, like I said, in the latter half, continue to focus on these lower weighted stocks that I still have good convictions in to try and bring up the total dividend yield. I want to get Ryokan below 10%. I don't want any individual company making up such a large income provider, because that has really screwed me in the past. I mean, going through 2020, guys, I mean, I got hit with GEO Group, slaughtered me, cut that dividend, one of my largest dividend providers. I mean, then you take a look at Ryokan that did do a dividend cut in early 2021 after the pandemic. I mean, I looked at things like MO and BTI, though they're great companies for dividends today. In the long-term perspective of things, I don't trust the business models, and I don't want the risk, because I think there's more risk to that than some of these other companies I hold right now. So between those dividend cuts, I mean, we probably would have been closer to 9,000 right now, and I would have been well on my track to 10,000. But again, I do not need these dividends today. So I do not want to solely focus my entire investing style on that. But taking a look, guys, scrolling down, sector allocation wise, I got over 30,000 in the growth vectors. This would be all my tech companies. So I kind of label this as like tech. Index funds now make up a little percentage. I've been trying to do what I preach here. Nothing huge. Wait, what are indexes at? Sorry, 7% is total for indexes. And the REIT sector is probably where a lot of my focus is lately. I do love REITs. I find they give me great exposure to many major tech companies like Amazon. I mean, even Ryokan had one of their largest tenants in these new buildings is going to be Shopify. I love using these REITs to cash flow off these companies that don't cash flow with great reliability. So I'm very happy, and I'm probably going to focus more on that to continue to fast track the dividend growth. But overall, guys, in the new realm of things, I've got 31% in growth. Keep in mind, some of that encapsulates Apple, Microsoft. So there is some dividend spillage in there, but the pure dividend plays are at 65% now. And I'm sitting on about 4% cash, which I have continued to weight up as well. So from a cash percentage weighting, I do want to get my emergency fund to something around $20,000, and I do not want to touch that, but to weight myself against any form of inflation problems. This is why I've been buying Bitcoin. Eventually, I'd like my Bitcoin position to get to about 10,000, and then I have a couple thousand sitting around in precious metals, but I'm going to try and use that as a pure emergency fund worth about 30 to 35,000 between those asset classes. And within the 20,000 cash, I want about 5,000 of that sitting in US dollars, which I already pretty much have allocated to. So that's kind of just where the portfolio currently sits, guys. In other news, just to update you on some of the stuff I've personally done with my family, this kind of, it was a hard decision for me to make, but thanks to the rhetoric in China, I did scale down some of the positions my family had in Alibaba. I really like the Chinese sector. I just don't like it in large weighting. There's just the political rhetoric, and what kind of hammered and nailed me into the ground was the fact that we saw them basically force, I don't want to call it a bribe, but all these big conglomerates, including Baba, that donated 1/3 of their cash position to the Chinese Communist Party, but not really the Communist Party. It was more into like things related to the economy. I mean, they're making these big tech companies invest into farming. And I get it. They're trying to bring up the lower half of the infrastructure, which makes sense, but they're doing it at the stake of shareholders, right? Like, I mean, Alibaba had almost as much cash as what like Apple does. I mean, like they had so much cash, and to have to liquidate 1/3 of that into a non-investment, a non-shareholder, or, you know, retail investor focused investment that would continue to scale the growth of the company. I mean, that's the true definition of communism right there, right? So I like this still. I know a lot of big investors are still holding on to these. I didn't completely liquidate the position. I think there is some good exposure, but when you look at something like VTI, like if you guys wanted some Asian exposure, the pure plays are extremely volatile right now, but you can own these companies through the total market index fund with Vanguard. And you'll see that this index fund is still trading up almost 20% this year, even though it has allocations to some of these tech giants. So you're getting less volatility. I mean, you might be giving up some of that upside in case Baba does decide to come back sometime in the near term here, but this is probably the best way to go about it. But like I said, I only scaled down the position by about half in Alibaba. Yeah, it was a bit of a loss, about a 30% loss on those half positions. But I think it's more appropriate, guys, because I just don't like the fact that this rhetoric is not changing. It's kind of getting worse. They're attacking the gaming sector now with Macau. It's just an ongoing event where you have to wait for this rhetoric to change before the earnings will actually start re-enlighting investors in the Chinese market. And we don't know how long that takes, right? That could take a very, very long time. So in light of all this, folks, I pass the question off to you. How has your portfolio been performing this week? What have you been buying and selling? And I'd love to know what you think about my personal trades, because it's nothing crazy. I mean, just continued consolidation into higher convictions. Again, it makes more sense at this point in my investing career. So stay cool, stay awesome, and I look forward to catching you tomorrow.